Coming up on this episode of the Stock Market Playbook podcast, we have Brian Feroldi. He is awesome. He does a really good job taking complex investing, stock market, economy, material, and puts it into a super understandable, super intelligible way to help you create your own method for investing in the stock market. You're going to love this episode. Stick around and see what Brian has to say about his favorite stocks right now, how he looks at the market, and how he plays it himself. Welcome back to another episode of the Stock Market Playbook. I'm your host, Jared Johnson, and we are very happy to have Mr. Brian Feroldi here with us. What is the best nickname for you? Are you the educator of educators in financial markets? I mean, I think anybody that knows who you are has enjoyed your material.
Sure, that sounds like a great way to go with it. When you work for yourself, you get to make up your title. So I just call myself a financial educator.
Financial educator. I think you do a great job. It's so funny. Every time I talk to people about financial markets, anything, they go, I'm a very visual person. And I go, I think most people with eyesight are visual people.
Yeah, exactly. Right? That would make you a human.
The small visually impaired population may not be as visual, but the rest of us are. And but one thing that I love that you do, I've been in the stock market and financial markets for 25 years, managing hedge funds and so on. And I still find stuff that you post, your infographics, I just think, what a great way to explain that. Like, you get all these difficult explanations that this number minus this number, whatever. You have this great flow chart and this infographic, and it's awesome. And so I think you're doing the general population a pretty good favor by educating.
That's my goal. That is absolutely what I'm trying to do. So I'm thrilled to hear you say that. And like you said, I am also a visual person, and I find that it's so much easier to grasp a concept when it's laid out visually. And in fact, as few words as possible to explain a concept is always my goal. Not always possible, but I think if you can understand something so much faster and easier when it's presented visually to you.
I need to, I think I need your services. I run a hedge fund, and we have some pretty complex option strategies. And occasionally, somebody wants to know the ins and outs of my option strategies. And so I tell them, and the glossy-eyedness happens, I would say almost immediately, where they're just like, whatever. I need a flow chart. I need like an infographic they can say,
I just wrote down that as an idea, so thank you.
That is awesome. So tell me, what is your background? What brings you to the financial education position that you're in right now?
Yep. So I graduated from college in 2004, and when I was in college, I studied business. And despite graduating with a degree in business, I would essentially consider myself to be financially illiterate. I knew a little bit about accounting. I knew a little bit about marketing. I knew a little bit about business law, international business, et cetera, a little bit about leadership, but we never really went over the numbers of like personal finance. We never went over compound interest. We never dove into the details of the stock market, how the stock market works, why you should care about the stock market. When I graduated, my dad handed me a very popular book back then and even today, Rich Dad Poor Dad by Robert Kiyosaki. And Classic. That book I just devoured in like a matter of like 48 hours. I just read the whole thing. I just immediately grasped the concept behind it. And that kick-started a love affair with all things related to money, personal finance, and investing that essentially continues to this day. And I find I'm the type of person that likes to dive deep into a concept, really understand it, and then ask myself, how would I explain this concept to myself before I knew anything about it to make it as simple as possible? So I kind of take that skill, if you will, and try and explain financial concept that I now understand as simply as possible to other people as a way to cement it in my own mind.
Oh, that is great. And it's such a shift that's been happening, certainly since you graduated college in 2004, right? Because my stock market journey began in the very early 2000s, about 2002 or so. And working, school, stock market, all this. And And I remember thinking to myself, this is really complex, right? And there was like, I mean, I'm struggling to even think about this. I don't even know if YouTube existed then. The internet was
Nope.
very sparse on the information that it had available, right? And we were only about, I don't know, maybe 20, 21 or 22 years pre AI. So that was out. And so you just had to figure this stuff out. And it's interesting because as we've heard a million times, and I have seen this to be true, the financial, the big players in the financial market don't want us to learn all of this because it starts to eat their lunch a little bit, right? The big mutual funds. I mean, are mutual funds even still a thing anymore? Because 20 years ago they were the thing, right? There was, I mean, I don't even know if there was an ETF 20 years ago, but it was limited what there was. And so now there's all this education and the curtain's getting pulled back, and there's people like you, and there's so many great resources online now that can just kind of simplify this process. And we've certainly seen a big change, right? We've seen a lot of people getting involved in the market, and we've seen this shift from the retail traders being the dumb money to actually, I mean, certainly the meme stock era was the dumb money just steamrolled the smart money. And so we have this big shift. How do you see it kind of going from here?
I think the last 20 years have been absolutely fabulous for investors. So many developments have come along. It used to cost quite a bit of money to just buy or sell a stock, and that was a massive barrier to just getting started in the market. Now, pretty much every brokerage out there allows you to buy and sell stocks with zero commission. Previously, the only way that you could really educate yourself was through books. That was really it. Now, no matter what platform you're on, it could be Twitter, it could be TikTok, it could be Instagram, it could be YouTube, you can find high quality creators that present information and teach you exactly what you need to know how to invest. You can now go to your phone with zero prior knowledge, set up a brokerage account in a matter of minutes, and put money and get money working in the market for essentially zero cost, and have unlimited access to information to educate yourself and follow and track your investments. It's been absolute boom times to be an individual investor. It's never been easier to manage your own money or to do well with finance. So I would hope that over the next 20 years, things just continue to get easier and easier, better and better. We have more choices out there. And to me, the easier you can make it to get started investing, the more people will do it.
I think that's right. What do you think the role of, and here's one of the big topics, right, that's out there like crazy. What do you think the role of like these prediction markets? What's the role they're going to play in this? Because like you said, 20 years ago, very difficult to do everything, right? And we still have this difficult, tool we use, like options, for example, and we have all the details with options, and sometimes a neighbor or friend will say, can you explain option trading to me? And I always just say no. Just YouTube has great material. But I mean, do you agree that like we're on this path of, I mean, like you said, really, actually, we're on this path of making things easier, simpler, more accessible to kind of the general population, which is awesome. And so we have the prediction market that is up and coming, right? And it's kind of taking this option trading concept and simplifying it, right? At the end of the week, will X, Y, Z be above or below this, right? Which is kind of an option trading concept, but now you can just bet on a prediction market. Do you see those getting bigger and more like a more important role in all this, or will they kind of stay in parallel? What are your thoughts on that?
I view it as just another asset class that's becoming available to everyday investors. And there's no doubt that they kind of scratch that gambling itch that a lot of people have. I think it's highly useful and informative when it comes to like politics or big policy decisions. You can make macro bets around it. I think it's much less useful when it comes to kind of like micro things. But net, if I could uninvent Polymarket or Kalshi, I would myself, because I don't think having more options out there to really gamble your money away are a good thing. But there's no doubt that people want these kind of products, and people will put capital into them. Like anything else, it comes down to just personal responsibility and how much percentage of your actual assets you put into them. Personally, I don't touch it, because why bother investing, or why bother putting money into a pure gambling product like that when I can put money into the stock market? These are living, breathing companies that have actual cash flow. They're productive assets that pay dividends and can increase their share price over time through things like stock buybacks and margin expansion. So that's the market that I personally understand, and that's where I'm going to stick. But there's no doubt that things like DraftKings and FanDuel and Polymarket and Kalshi are here to stay.
For sure, they do seem to be growing quite a bit. And on that topic, so personally, are you more of a long-term investor? Is that your approach to the markets?
Yep. If you look at my top, I own about 30 stocks in total. I actually did this analysis the other day. Of my top 11 holdings, the one that I've held the least amount of time is 8 years.
Okay. All right. So you're really in it for the long haul. You're looking for the big gains. How do you decide, if you have 30 stocks that you're holding, what's kind of your decision process there?
Yeah, it's fairly complicated, and it's an always evolving thing. But I built a checklist for myself, just like the same way that most investors do, where I spend a lot of time building a system that allows me to analyze companies or analyze businesses in a way that is aligned with what I'm looking for in a company. If you had to classify my investing style, it would be high quality growth. So I'm looking for companies that are profitable, high returns on capital, clear and established moats, strong tailwinds behind them, invested management teams, kind of as low risk as possible. So low execution risk, low disruption risk, low customer concentration risk, et cetera. And then I take these companies and I put them through a very simple scoring system that I have for myself. And then I try and allocate my capital to the highest quality stocks and ideas that I have that are trading at the lowest valuations, or at least that's what I hope to do. There are certain times that I override my model because I think something is going to do better than another. But as a general statement, I try and fill my portfolio with high quality investments that I can just buy and hold for long periods of time.
That's excellent. For somebody that's just getting started, for example, and saying, okay, I'd like to create a list myself. I don't understand all those concepts, right? I don't know how to look at all that stuff. What is for somebody brand new, right? What if you had to boil it down to like 2 or 3 of your most important, either fundamental or otherwise, metrics that you look for in a company, in a stock, what would it be? What would be like a simplified version of that?
Well, I think the version that I currently have is about as simple as it gets, and I don't think you can really boil down stock picking to just a few numbers. Well, I actually do think you can boil it down to just a few numbers, but it really depends on finding the right company first. Once you've found the right company, then you can boil it down to just a couple of numbers. For example, I've owned MasterCard for 10 plus years. It's one of my top holdings. It's a company that I have a tremendous amount of capital in, a tremendous amount of faith in. When I'm reviewing, now that I've done the work on MasterCard, I've identified this is a high quality company. It's got a competitive advantage, long-term growth way, et cetera. When I'm looking at the earnings reports, I can be like revenue growth, earnings growth, dividend, capital returns, right? Those 3 metrics are all I need to know for, is this thesis on track or not? So now that I've done the hard work of identifying this is a great company, I can track those few metrics over time and check the box. But you can't do that same analysis on a company that's, say, earlier in its growth phase. Like a very popular stock these days is Hims and Hers Health, which is a company that's focused on direct-to-consumer healthcare. You can't look at those same 3 metrics with a company like Hims and Her because it's just earlier in its growth phase. Moreover, you have to take into account extra risks about it's a high growth company. It's entering new markets. It has different competitive dynamics in there. So its moat is nowhere near as wide as a company like MasterCard's is. So you would have to first do the fundamental analysis on, is this a high quality company? Then your goal is to say, what are the 2 to 4 metrics that really matter that will make or break this company, and then tracking them over time. So you can do simplified analysis and boil down a couple metrics per company. I don't think you can do that for companies in general.
Sure, that's interesting. So what's the argument then for, obviously a company like MasterCard has killed it over the last decade. I mean, they're up like crazy. So obviously a great call. Now, what's the argument for not just putting a bunch of money in SPY, just buying SPY and QQQ and going about your life and doing zero analysis and just letting it roll?
That's a fantastic argument. In fact, I think that should be the default move for 99% of the population. And I say that not because I don't think 99% of the population is smart enough to pick their own stocks or do their own analysis. It's that 99% of the population doesn't have the interest in doing the work necessary to learn how to find good companies, analyze them, buy and hold them for long periods of time, and then have the ability to look back at their past decisions and ask themselves, is this something I want to do? Is this a way that I want to spend my time? The reason that I personally own a lot of individual stocks is because I'm in that weird 1% of people that enjoys following the market. I enjoy analyzing companies. I've said this for years, but I would rather listen to a Tesla earnings call than I would watch the next blockbuster movie. To me, the Tesla earnings call is more interesting than watching the next Avatar movie, for example. So I actually enjoy doing the work and really learning about businesses because the whole concept of business and investing just fascinates me. But I realize that most people do not agree with that. So that's why for the vast majority of people, I say, no problem, dollar cost average into high quality index funds. And congratulations, you're done with investing. But if you do have an inclination, and if you're listening to a podcast about the stock market, you're in that weird 1% that literally enjoys learning about the market. So you're a great candidate to take the extra step and start to analyze individual businesses. But it's purely based on interest, nothing else.
It's an interesting point you bring up because I've talked to a lot of investors over the years and so on, and weirdly, and maybe not weirdly, because you love the stock market, I love the stock market. It's what I do all day. It's what you do all day. But interestingly enough, I have actually found that most people I talk to become very interested in the stock market, right?
Mm-hmm.
Wait, and I almost feel surprised by this because I think, you're watching charts, you're reading reports, you're seeing what impact this news has on this sector, this stock, or whatever. And on the surface, I think that sounds painfully boring. That sounds terrible. But weirdly enough, so many people that I talk to are obsessed with that. And I mean, I am. I have never thought to myself one time like, wow, this stock market stuff is just a bunch of numbers. And there certainly are boring ways to go about it. I think if you're doing an approach that doesn't resonate with you, then it could certainly be boring. But it does seem almost on the surface that the stock market should not be as fun as it is, and it is fun. I love going on cruises, but I always find the internet is a problem because I need to check every day, right? And so it's a whole thing. But so in that space, you're sounding like you kind of have a time horizon. We'll call it the Warren Buffett time horizon, which your holding period is forever, right? or thereabouts. So how do you cycle through stocks? Do some of these stocks kind of fall out of the category and the criteria that you like, and so you start to sell those and fill the spot? Are you always looking for new stocks to put in? Do you find yourself full and you just can't fit any more in? How does that balancing process work?
So the way that I consider, so first off, buying stocks is a heck of a lot easier than it is to sell stocks. Buy decisions are often very easy. Great company, great valuation, I want to own it, right? It's very simple to buy. Selling is incredibly difficult because then you're like, well, is the thesis broken, or is the company growing slower, or is something not playing out as I want? Or maybe the company has done very well, but the valuation is really high, and then you have to think about the tax consequences and what do I do with the capital? Do I put it into another stock, or do I just hold it in cash? Selling decisions are way harder than buying decisions. The strategy that works for me, the individual investor, and keep in mind, I'm managing my own money. I don't have anybody else to report to. I'm not interested in producing an annual report that looks good or doing any sales or anything like that. That gives me a massive advantage over professionals that are managing other people's money. So with that mindset in the way, I scale into positions slowly. I build up positions in companies very slow over periods of time. That allows me to see how the company is performing, and I get to know companies better after I buy them, and I can track their execution. And then once I buy them, I'm very reluctant to sell them. Very reluctant to sell them. The reason I'm reluctant to sell them is that I've analyzed my selling decisions in the past. And even if you get 9 out of 10 selling decisions correct, if you sell Netflix in 2010 or Nvidia in 2018, or if you sell Intuitive Surgical in 2013, all of your other sell decisions are irrelevant, because selling a stock that is going to go on to do tremendously well for you over time early is the biggest mistake that you can make in investing by far. So because of that, I've developed a strong bias against selling, because to become a stock that enters my portfolio is extremely hard. So if it's gotten into my portfolio, there's something about it that I really like, and I want to give that company enough time to really execute against the thesis that I have for it. And if you look at my biggest positions today, they're companies like Mercado Libre, they're Amazon, they're MasterCard, the Visa is in there, Intuitive Surgical is in there. These are companies that I made the decision to buy a long time ago, multiple years ago, and then the companies went on to do even better than I thought that they were going to do. And by not selling them, they become bigger and bigger positions in my portfolio. And the stocks that I got wrong, or that have dramatically underperformed, they have faded away into obscurity in my portfolio, and they become smaller and smaller positions over time. So the reason my portfolio is positioned the way that it is today is because I bought great companies a long time ago and then didn't sell them. So in a way, I don't have to make I don't have to make allocation decisions in my portfolio. The market does that for me by tracking the performance of these companies. So my portfolio naturally gets more and more concentrated into my best performers and less concentrated into my poor performers, which is exactly how the NASDAQ works, the S&P 500 works, and all those market cap weighted indexes. So I like the idea of buying companies and then letting them run for a long period of time, and my portfolio naturally concentrates itself.
I love that. That's interesting. So within that portfolio of these great companies, these great stocks, is there any space for the two things that have really made it into people's brains and probably portfolios lately? Metals, precious metals, gold, silver, and crypto. What are your thoughts on those two things in your own personal portfolio?
Yep. So I'm a disciple of Warren Buffett, and I like the way that he categorizes assets. Yeah, there's basically 3 types of assets. There's currency-based assets, which are your checking account, bonds, etc. There are unproductive assets like gold, like metals, like cryptocurrencies, and then there are productive assets such as stocks or real estate or privately held businesses. Now, all 3 of those categories you can make an argument to hold. And the second one, non-productive assets, which are metals, commodities, and crypto, there are periods when they can do extraordinarily well. And we've seen gold and silver and all that kind of stuff do extremely well over the last 18 months. In particular, silver in particular, I think has gone like parabolic over the last couple of weeks. And if you look back historically, this is something that does happen. There are periods when gold and silver dramatically outperform, and people like Ray Dalio stress having exposure to these commodities in your portfolio as part of an all-weather strategy. If you pursue that kind of strategy and that fits your personality, have at it. I think that there is a reasonable, there are logical reasons to do so. That's not the strategy that I choose to pursue. I keep my money in cash and stocks. And that's pretty much it. I want my money in either cash that could allow me to buy stocks in the future, or stocks which are productive businesses. That's the way that I hedge for inflation. That's the asset class that I understand the best. So that strategy works. I think will work very well over the long term, but over short periods of time, and I consider short to be 5 years or less. There are periods when pursuing a cryptocurrency or a commodity exposure is quote unquote the right thing to do. So that might be the right thing to do for some people. It's not the right thing for me.
I gotcha. What what do you do with your portfolio when conditions do change? Like, for example, like you said, we've gone through this period where we've watched gold and silver, for example, go crazy. A lot of the commodities are really starting to move right now, and there's all the reasons and thoughts and ideas behind that. Um, does that change your thesis at all, or do you stay with kind of the key metrics that you look for in your individual companies, regardless of what the kind of overall market conditions are?
Yep. I don't change my strategy there. I try and buy companies that will do well in really any environment. There are certainly companies, I really try and have zero exposure to companies that depend on forces outside of their control. So let's say you're a company that produces gold, right? Like you're a miner out there. You could be the best miner in the world, have like buttoned up operations, find gold mines, really do well with exploration. But the success of your company is going to depend entirely on what does the price of gold do. If you're an oil company, your success is going to be what's the price of oil. And those are factors that are completely outside of that company's control. They have no control over their pricing. I am not interested in those kind of companies. The management team does not control the price of their product. I would much rather invest in companies like Microsoft that controls the price of the software that they pay, or MasterCard, which controls the price that they charge on transactions. So for me personally, I like to invest in don't invest in companies that don't control the price of the thing that they sell. But again, I recognize that strategy and those companies can do extraordinarily well and during periods like now when the underlying commodity is appreciating very, very rapidly. But I think it was Nassim Taleb that said, "I've never seen a boom not followed by a bust." And I think that right now we are definitely in the boom phase. I have no idea when the timing is going to be, but high commodity prices attract supply, and attracting supply leads to lower commodity prices. So when the timing of that is, I don't know. I don't care. I don't play in that market.
Do you have right now? Are you exposed to many of the AI stocks? Have they fallen within your parameters of good companies to buy?
Depends on what you mean by the AI stocks. Like I've held Google for 16 years. I've held Tesla for 11 years. I don't personally own NVIDIA. I do own Meta. And I've held that for 10 years. So in a way, when I bought them, AI was not a part of the thesis at all. But if you look at their valuations today, AI, especially for Tesla, is a big part of the thesis. So I do participate through those methods, but I don't have any quote unquote pure play AI stocks out there.
So speaking of those stocks, those are interesting ones. Tesla obviously has done amazing. Meta's done amazing. Google's done amazing, but they've had some wild moments in there. How do you look at volatility? I mean, Tesla, for example, has had at least 50% drawdowns multiple times within the last decade, if not. I mean, I think Tesla's maybe had 70% drawdowns, but at least 50. So what is a drawdown of 50%, for example, in a company that you own do to your process? Anything? Nothing? Something?
Yeah, they're always challenging, but I've lived through enough of them and I've seen them happen to basically every stock that I own. Every big winner that I have, without exception, has fallen by 50%, 60%, or even 70%. I mean, if you talk about volatility, I've had my Netflix stock fall 80% twice. Right? That's peak to trough, 80% drop twice. And I know some very smart people that followed Netflix and just completely sold out. I have not sold my Netflix at all. And every time I've held on, it's been really rewarded. And the remarkable thing about that is if you dive into the details of Netflix's business, like the actual business, and if you look at subscribers, revenue, operating margins, they're actually extremely predictable and extremely stable. But the stock price swings wildly based on the emotions that investors have and the feelings and the sentiment that exists in a company like Netflix. So I have accepted that if you're going to be investing in individual stocks like I am, the price that you pay as an investor for high returns is high volatility. That is the price that you pay to own stocks. And I think if you think that you can sidestep that price by selling when the stock is high and then buying it again when it's low, I think that you are diluting yourself. It is so incredibly hard to try and time the highs and the lows of a business. And typically when a stock is fallen 80%, it's not for no reason. There's good reasons out there that the stock has fallen that dramatically. So rather than try and time the high and time the low, I simply buy the company, hold it for a long period of time, and accept that occasionally the stocks that I own are just going to be smashed.
Tis the stock market. So on that note, I'm always very interested in the psychology, and I wouldn't say it's very complicated, but nobody wants to buy dips and everybody wants to buy rallies. And it's an interesting phenomenon. It's, I always say it's like somebody saying, here's a Ferrari and it's $1,000. And you go, no way, I'd way rather pay $100,000. Right. And it's like, why does this make sense? So on that note, when you have a stock like Netflix that has dropped 80%, and you're just holding it, you go, hey, my time horizon is 10 years. So whatever, we're going to come out of this. Do you try to add to your position at all? Is that part of your concentration building, or does your concentration increase by just the value of the stock increasing?
Yep. So once it reaches a certain percentage of my portfolio, typically about 5%, I don't try and add to that I don't try to add to that stock anymore. To me, I've put enough of my capital into the stock. Now it's up to the company to do the performance and to earn a higher position in my portfolio. I do occasionally buy more of a great stock, a great business when it falls due to, unforeseen circumstances or the sentiment on a company really changing. But typically speaking, once a company hits 5% of my portfolio, I don't tend to add to it or really subtract to it. I just kind of like let it ride and do that from there. So I focus on my buying on more of my smaller positions or companies that I want to buy into the future. But that's the strategy that I have found is the best fit for my personality.
I like it. And I think that's an important point, right? You do have to have a strategy that fits your personality. If you find yourself stressed out by something or bored by something or whatever, it's going to fall apart. So it's certainly got to be tailored to the individual. Here's a topic that is silently making the headlines a little bit. Is there a space for you in treasuries?
So right now I have about a 20% cash position in my portfolio, which is like an all-time high for me. The reason that I have so much cash is mostly a play on the valuations that I see out in the market. I think that the market, as a general statement, is quite expensive when compared to historic norms, especially when factoring in where treasuries and interest rates are. So my brokerage account, I use Interactive Brokers, and Interactive Brokers keeps any cash that you have on the sidelines essentially invested in a program where I get like a 3.1% dividend yield on that, something like now. So given that cash plays such a good amount on my Interactive Brokers, I don't see the need to transfer that into treasuries to take advantage of interest rates. Moreover, if you put money into treasuries, then you're really taking on interest rate risk because the value that you are playing will be impacted by what happens to interest rates. So I don't touch treasuries myself, although I fully acknowledge that they can be a good addition to some people's portfolio. It's just not the extra yield that I would get for going into treasuries does not, in my view, compensate me for the risk I'm taking on for the interest rate risk that you could be taking on.
Gotcha. It's definitely an interesting spot right now. I know, speaking of Warren Buffett and he, before his retirement, I would like to say untimely, but I think he was CEO for like 65 years or something like that.
He had a pretty good run.
He was CEO longer than, 80% of the world has been alive.
Right.
So good run. But, he was always infamous for having large positions in cash, which he would put in treasuries, I believe. Right. I think I've read that in many places. And, to be kind of north of $200 or $300 billion in treasuries is is wild. It's wild. He should have just opened an Interactive Brokers account. You
What
know,
was he thinking?
what
Well,
was he thinking?
and to be fair, if I was also managing 100 plus $1 billion, I think the 0.2% extra that you get, that's real money.
That's fairly significant. So that is great. Well, you have some very interesting takes on all this. I think your process is very interesting. I think a lot of people can learn from what you're doing and how you do it. And like I said in the beginning, you do a really really good job taking complex principles and concepts and kind of making them intelligible for people that don't have degrees in finance. Although, as you mentioned as well, I have a good friend who is a professor at a local university here, Brigham Young University, and he's a professor of finance. And he says, he and I always talk and laugh, and he says, I'll tell you how the market should work, and then you tell me how the market does work. And,
Yeah.
and we have some great discussions.
That's right.
But
The theory of investing and the actual art of investing are different things.
oh man, and on that topic, books about the functions of the market are wild. Those are so difficult. I go to YouTube, go to TikTok. They have great information there. But that's great stuff. Brian, thank you a million for joining us. Tell people how and where they can find you. I'll, of course, have some links below on here, but just tell people a little bit of where they can follow you and some of the offerings that you have with what you do.
Sure. So whatever social platform you prefer to spend time on, I'm probably there. If you search for my name, I put the most time and effort into YouTube. So if you're interested in video content, just search for my name, Brian Feroldi, on there.
That is awesome. Okay, and like I said, we'll have all of your links below this video. But Brian, awesome stuff. Thank you for your time this morning. It was really great chatting with you, and we will definitely, hopefully, have you on again in the future.
Sounds great. Thanks for the invite, Jared.
Thank you.